Hey there, everyone. Today on our Friday final bar, we'll talk about the S&P 500, the NASDAQ opening higher but giving back all of those initial gains, finishing flat for the day. Familiar sectors at the top of the leaderboard, and it's not the growth sectors, utilities and energy finishing the week in a position of strength. Finally, we'll open the final bar mailbag. Are there good income alternatives to bonds and cash? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. I was talking to a couple of peers in the industry earlier today, other parts of the industry, more in the personal finance space, and they asked what I do, and I try to explain. I help people think about what's going on inside their head and what's going on the charts, what's going on in the markets, and helping them make sense of those two together. And I would argue that charts and a disciplined process of using the technical analysis toolkit, if nothing else, gets you out of your own way. A lot of times your biggest competitor are not other investors, and it's not the market, it's yourself, and it's your own sort of predispositions. I think a good use of technical analysis, using it in a consistent and effective way, can really help you make better decisions. And hopefully through the course of our show here, we can share with you some ideas. Quick personal story, a bear just tore into our backyard last night and got into our trash can. First time in 4 years in the Pacific Northwest that's happened. I don't want to draw too many conclusions, but the fact that I now have bears in my backyard is making me a little concerned about market conditions. With that in mind, let's set the stage with our market recap. We're going to wrap the week looking at the market conditions today, connecting it to the overall trends we've seen recently. First off, we're going to get to a poll question. We asked you recently, which sector do you think performs better over the next 3 months? Consumer discretionary XLY, consumer staples XLP. Simple question. Do you want to be on offense or defense in the consumer space? I was struck by the fact that 6 out of 10 of you that responded say you want to be more defensive than offensive. I think that's pretty telling, because not too long ago, I would have found that incredibly hard to believe that we would have that much bearishness happening. And again, it's not an overwhelming amount, but enough people thinking that over the next 3 months, you want to be a little more defensive than offensive. What's also interesting about that, we're here at the beginning of September. 3 months from now gets us into the beginning of December, which means over half of us are expecting sort of a period of dislocation, not just next week, but over the next quarter, right? Think about the ratio of the XLY to the XLP. And one of my guests recently, Adrian Zadunchik, highlighted that ratio and talked about why it was such an important ratio to watch. We'll look at my chart of offense versus defense. And what's interesting is the trend has really been favoring offense, right? If you look at the cap-weighted XLY versus XLP, if you look at the equal-weighted versions, it's certainly more favoring offense over defense. We've been in a pretty good uptrend. Now, I had highlighted this potential rotation, really didn't play out. It actually reversed back higher. So these ratios have not broken out. I think that might be an important thing to note, right? For the last couple of months, I mean, I guess if you really think about it, sort of gone sideways, right? And while a lot of charts within consumer staples like food products have been struggling quite a bit, there are other areas of the market like beverages that have actually held up quite well. Think of consumer discretionary. There are charts like Tesla, which has taken a bit of a breather. Stocks like Amazon are actually holding up particularly well. And I think there's that mixed bag enough of stocks working and not, that this key ratio is sort of chopping around here sideways. It's really interesting as you look at the market right now. There's a very big spread, I would argue, of strong outperformers to strong underperformers and everything else in between. It's a challenging period. There's no doubt about it. So let's do our best to highlight some of the areas of the market that are performing well. By the way, that poll was on our social media account, so make sure you subscribe to our YouTube channel. Go ahead and do it right now. Also, give the video a like. We would so appreciate that. Also, follow us on X, other social media platforms. You won't miss the next poll. Let's continue on here with our Wrap the Week segment. Let's look at what happened today in the markets. As I mentioned, sort of a strong open, but weaker going into the close. The S&P finishing just a little bit slightly higher going into the close, around 0.1%. NASDAQ essentially flat for the day, finishing back at the zero line. So that keeps the S&P 500 just below 4,500. We'll call it 4,460, and a little bit below that. The NASDAQ composite, of course, flat from yesterday's close. So you're seeing some things working, but it's in some fairly defensive and maybe cyclical areas that are at the top of the leaderboard today. We'll get to that here in a minute. Small caps continuing to not impress, particularly on a relative basis. My conversation this week with Ari Wald really focused on small caps and the lack of upside follow through that we've seen in the small cap space. Volatility, the VIX remaining fairly muted here. Volatility actually coming off a bit today. The VIX back below 14 slightly to 13.9. And again, what I'm looking for in this environment, kind of dangerous signals, right? I'm looking for signs that this is not just a brief pullback, but something more significant. And I think some of the measures of breadth and sentiment, which we've highlighted, could be part of that story, part of that narrative that you could understand. But also looking at volatility, right? And a spike in volatility would be a big time red flag because the market most likely doesn't continue higher on exceptionally strong volatility. A spike in the VIX most likely means there's elevated uncertainty, elevated fear, and I would say elevated potential for further downside in the equity indexes. Let's look at some other asset classes here very quickly. Not too much of a change to the yield curve from Thursday to Friday, to be honest with you. 5, 10, 30-year points, and even the short-term, 3-month point, pretty similar to where we were yesterday. So 10-year yields holding steady around 426, long bond yield around 433, and what we'll see when you look at charts like NVIDIA and Adobe and other growth stocks that have been doing particularly well and now maybe showing signs of weakness, particularly weaker momentum, arguably higher rates are a big part of that. My conversation this week focusing on interest rates with Willie Delwich. It was on yesterday's show. Really, really interesting. And again, I mentioned some of the great conversations we've had. It's had some really good, really thoughtful guests. We'll keep bringing some good insights and expertise along with the final bar ride with us. Dollar index, by the way, not too much different from Thursday's close. Same to be said for commodities. I think the long-term story for commodities could certainly be an opportunity. This week, not a big up move for the commodity space overall, particularly gold and silver, which again today were flat on the day. Copper down the most, about 1.5%. That's using a copper ETF. Crude oil prices pushing a little bit higher, and I think that higher chart of crude oil, if you've not sort of followed and tracked that uptrend and recognize the strength in crude oil, how that impacts an energy sector, I would certainly pay some attention to that over the weekend during a weekly chart review if you have one of those. Finally, cryptocurrencies, Bitcoin down about 1.5% today, Ether down 0.8%. I just saw the news that I think it was Kathy Wood and the ARK funds applying to do an Ether ETF. Again, there's been a lot of applications for cryptocurrency ETFs. There haven't been a lot of approvals for those ETFs. So take what you can from that. Cryptocurrency space, again, still sort of choppy sideways. Bitcoin hitting that 25,000 level and holding that for now. And I think as long as that holds, this is not a chart that's in trouble. It's a chart that's at the lower end of the range. We break below Bitcoin 25K. I think all of a sudden that chart has a very different look. This is a space that's not holding support, and I would be concerned about further downside potential. For now, at the lower end of the range, which is not on its own a horrible place to be. Looking at sectors here very quickly, I mentioned in the introduction two of the sectors doing well. It was sort of the two winners and then everything else. It reminds me of the old days of the Big Ten. They called it the Big Two and the Little Eight, which is a horrible thing to refer to, but that's what's top of mind as I'm looking at this. Energy, XLE up 1%, utilities up 0.9%. Everything else a lot closer to zero or even down a little bit. At the bottom of the list, we have real estate down 0.7%, industrials down 0.5%, healthcare and discretionary essentially flat for the day from Thursday's close. Let's go to a daily chart of the S&P 500 and just see how today's movement sort of fits into the overall trend here. When I'm looking at the chart of the S&P, this is kind of the base case that we've been talking about on the show. This three-wave correction, that initial sell-off in August, the brief rally here into the end of August, and now coming out of the Labor Day weekend. Again, this week, shortened holiday week. You see things rotating lower. The base case that this is appearing to track is sort of this ABC corrective phase. There are other names to sort of describe that. That's kind of how I refer to it. Again, there's no guarantee that this sort of pattern plays out exactly as prescribed. And I think a lot of times technical analysts certainly can get into trouble if you sort of lay out this future path and then just assume that the market's going to look exactly like that. Again, I wish we had a crystal ball that could tell us that sort of thing, but none of us do. The best thing we can do is look at market history, look at the history of technical analysis, which is based on analyzing trends and seeing what works and trying to repeat those sort of tools. This sort of three-wave pattern has happened quite a bit, which is why many of us immediately see that as a likely outcome. So I like putting these lines on the chart just to sort of track what my base case is. And I keep referring it to as a base case. I would encourage you to think along those terms as well. What's sort of your most likely scenario based on all the evidence that you gather? And then think about some other scenarios. And I think that's where you want to do what's called a probabilistic analysis. What would happen if the S&P rips past 4,600 and goes higher? What stocks would most likely do well if that's going to be the outcome here over the next couple weeks? What if this is just the beginning of a much deeper drawdown to 3,800? I don't see that as a necessarily likely scenario, but it's certainly possible, right? Theoretically possible that we could get there very quickly. What would happen, right? What would you see? What other information could you use to confirm the fact that this is getting worse? And not once it hits 3,800, but between now and then, right? There's a lot of room between current levels and a deep downside projection, right? What would happen? What types of sectors would do well? What would things you're holding do in that scenario? And by thinking through those potential opportunities, that helps you be a little more prepared regardless of what happens, right? At least you've already thought through that potential outcome. So I see this as a likely play for the markets here over the next couple weeks. This takes us to options expiration, which will be the third week of September. This takes us down to trend line support. If things play out this beautifully, it will be just a really nice sort of idealized version of a pattern that many of us have studied for a number of years. But I would be very prepared for things to not look exactly like that. And let's keep that in mind as well. Let's look back at the what we call the wrap the week charts. What I like to do on a Friday is look back at the week that just happened. So we had a shortened holiday week. So we need to start this chart here on Friday's close. The first, we skipped the Monday holiday. We had a 4-day trading week. Here's what happened. The S&P is down here in black, down 1.3% for the week. The NASDAQ actually almost identical returns, slightly underperforming, but it was a rounding error, not much. A couple things really underperformed. And it's emerging markets, which were down 2.3% this week. Small caps down 3.6%. Some of my conversations recently really focused on small cap performance. And if you're looking for a primer on what this means for small caps to look like this, I would go back to Ari Wald earlier this week talking about why small caps can be a great measure of risk appetite for investors. Go back to my conversation with Doug Ramsey of the Loophole Group a couple weeks ago. We talked about small caps and how they've done in previous market cycles. That was actually a really interesting conversation as well. Review those and then reflect on the fact that small caps are down 3.6% this week. Not an offensive sort of reading there. Gold, not too much outperforming the S&P, down about 1.1% for the week. In red, we have bond prices down 0.5%. That's using the TLT, which is a sort of a long duration treasury ETF. Everything else was up for the week. Bitcoin actually finished narrowly positive, around 0.3% up. The dollar ETF UUP was up 0.9%. And here in brown, we have the crude oil ETF USO, strongest performer, up 1.8%. Energy, if you'll note, every time I have a guest, I always try to get in two general, questions or directions. Number one, if you're bullish, what would tell you you're wrong? And if you're bearish, what would tell you you're right? I always like to ask what would you need to see to change your mind kind of question. I've always found that to be an interesting, thought process to go through, just to see what sort of danger signs people are looking for. And also, where do you see an opportunity, right? If you could buy one thing today, what would it be? Have you noticed how many of my guests have been talking about energy? And that is a multiple discipline sort of answer. The technical argument is it's going up when a lot of things are not doing so. So that's noteworthy. But the more macroeconomic environment, like we've talked with some of my recent guests, focusing on things that tend to do well when rates are high and when rates remain elevated. Energy kind of checks all those boxes. It is hinging on crude oil prices probably going higher or remaining higher. That's kind of happening. And so energy, continuing to be a position of strength. Again, finishing at the top of the leaderboard or toward the top yet again today. We're going to go back to the dashboard, round off our Wrap the Week segment by looking at a couple of these charts here. So again, if you're a StockCharts premium member, which of course you all should be, I think it's it is such a low cost for the value that you get, just the information you have access to. It's pretty cool what you can have available just on a website like StockCharts.com. And I would encourage you to customize your dashboard as I've done. I have 2 charts that I look at every single day, often multiple times, because it's a great reference point to just remember whatever I'm looking at, this is what the market conditions are. And I like having charts that just remind me the big picture within which I'm trying to operate. If I'm buying or selling any individual positions, this is the background to those decisions. My market trend model looks at 3 different time frames: long term, medium term, short term. Long term would be like a couple years out or a year plus. Medium term, maybe a couple weeks to a couple months. Short term, a couple days to a couple weeks. The short term model almost, and I'm talking really close to going back negative, it just barely, I'm talking 0.03. It's so close. If I had a neutral reading, it would be neutral, but I don't. So technically still positive here. Medium-term model remaining bullish as the long-term model does as well. So the market trend model that I use, which is using exponential averages on weekly data, tells me that the trend overall has been positive. And I would argue that's driven in no small part by the strength in charts like Amazon and Nvidia and other leading names that have continued to hold up just fine. You're seeing some of those names roll over, right? We're seeing Apple roll over. I think we're seeing signs of charts like Nvidia nearing an exhaustion point. Those things play out as I would expect. I think this model turns negative very quickly, but it hasn't done so, right? I mean, you've had these little sort of changes, but overall it's remaining fairly strong. That just tells me that overall the trend is still okay. This model starts to turn negative. That's what confirms to me, okay, we need to be thinking more defensively, focus on income and capital preservation, not there yet necessarily based on the trends purely. Now, having said that, let's open up the hood of the markets and look underneath and see the operation of the engine of the markets, which would be things like market breadth, which tells you about participation. Here's the trend in the S&P. Here's a trend line using the October and March closes and lining it up to where we are. You can see right now it lines up level just above 4,200. We're well above that trend line. So, with things like this, with a market that is a bit of a question mark, maybe putting in a lower high here, I always like to draw a line in the sand. What's that level? But as long as we stay above it, just don't worry too much, right? Things are just not getting that bad. For me, it's 2 things that I'm looking at: this trend line and also the 200-day moving average. And as long as we remain above those levels, things just aren't that bad. And there's a lot of space between the current close on Friday and 4,200, right? That's a couple hundred points away, which means there's a little more room for things to correct, for things to pull back, and still be within what I would call a fairly orderly uptrend. Now, here's the thing. Some other things are actually a lot closer to that trend line. The NASDAQ Composite just recently bounced off of that trend line, as did the advanced decline line using the New York Stock Exchange. It's actually bounced off of there a couple weeks ago, late August, and now once again rotating back down to that level. The AD line starts breaking that level. The NASDAQ starts breaking that trend line. Tells me more and more likely that the S&P follows suit, and these are just the leading indicators kind of rotating lower first. Now, the reason why I would say that's a distinct possibility is because the breadth conditions have become less and less bullish. We're now down to 35% of S&P members above their 50-day moving average. That's down from around 90% in mid-July. So in the last 7 weeks, we'll call it, from 90% to 35%, that means what, 55% of the S&P members were above their 50-day a couple months ago, and now below there. So that shows you how many things have been breaking down short-term support. Now, this is not long-term support, so things like the Bullish Percent Index still above 50%, percent of stocks above their 200-day right around 50% as well. But overall, I think we're nearing the point where this starts to look a lot less rosy of a picture. As I mentioned, offense still outperforming defense, and that's one of those areas of the market that certainly has not gone to defense. And this is why I'm not pounding the table and saying, here are clear signs that the market's going down big. I'm not seeing that yet, and those would be breadth conditions getting a lot worse. That would be the S&P not holding support as opposed to still being above support. It would be defense starting to outperform in a much more consistent way. You're seeing a little of that, like with utilities at the top of the list a couple days this week, but not enough, I think, to have a real danger sign overall. Couple other quick things to highlight here. Actually, we need one chart and then we're done here. Russell 2000 ETF, and I would just highlight with small caps. As you're thinking about the S&P and thinking about the NASDAQ, if the Russell 2000 or the S&P 600 is not one of those third things that I would look at, I would inject it into your process immediately, because small caps tend to do better in offense. If the markets are going to recover from here and it's not just the mega cap growth stocks anymore, small caps would have to do a lot better than they have. They're still kind of down below or right around the 200-day moving average. This is not a bullish configuration yet. I think this is still a sideways pattern at best. If you look at the last year, even a year and a half for the Russell 2000, we're essentially flat for that period. So think about what the S&P and the NASDAQ have done from the October low to where we're at today, even with the recent pullback, and think about all those things that the Russell 2000 has not done. Watch this chart if you want to see risk appetite illustrated in price form. We're going to open the final bar mailbag here in a moment. Before we do so, a couple quick announcements. First off, we would love to hear from you. Our mailbag that we're going to open here in a moment is fueled by people like you sending in your questions. What comes up as you are trying to use the StockCharts platform, trying to use technical indicators, anything else we talk about on the show? Our email is thefinalbar@stockcharts.com. On X, tag us at FinalBarSCTV. On YouTube, of course, just drop a comment below the video that you're watching. While you're watching this video on YouTube, do me a favor, like the video, subscribe to our channel. It would help us a great deal. We're right around 92,000 subscribers. Won't you help us get to 100,000? That'd be such a great milestone for StockCharts TV and will help us help other investors make better decisions. Let's open up the final bar mailbag, and here gets question number one. Dave, to what extent do the McClellan Oscillator and the Bullish Percent Index match up? You know, I really appreciate this question, and there's this great, I think, a great source of this question, I guess, or a great justification. Thinking about different breadth indicators and how they're related is a really good exercise. A lot of times I feel like investors, particularly earlier on in their journey, tend to just blindly follow things. Someone says something and they go, all right, I need to just watch that. And I think way too much in 2023 and in recent years, you know, people are sort of encouraged to blindly follow this signal. All you need to do is do this and you're going to make X amount of money. And life and certainly the game of investing is not that straightforward and not that easy as that implies. But thinking about different breadth indicators, they're not all the same, and they actually follow very different data and sometimes. And I think looking at things that are too similar is not helpful. Looking at things that are very different can be quite helpful, and looking at the relationship between those signals. So the indicators and the tools that I use a limited number of things in each different bucket, because otherwise it's just noise, right? And you're sort of confirming what you already know. This chart that I'm going to show you here has the S&P 500 and then both of the indicators that you asked about. The McClellan Oscillator is at the bottom. The Bullish Percent Index on the S&P 500 is here in the middle panel. Now, I use these indicators and I show them in other charts, but you know, it's great to remind you that I think that you can combine these indicators on one chart. So if you have two different indicators, you're thinking, how are they related? How are they similar? How are they different? I would create a chart and look at them together. Look at what the charts tell you. So the tickers here, if you look at the bottom, $BPSPX, $NYMO, those will give you the indicators here. And I'm just looking at the S&P as well, just to see how they relate to the overall movement. So how are they related? Well, you can see certainly some similarities, right? You can see that they tend to be stronger in similar times. They tend to be weaker in similar times. Now, these are derived from very different data sets. The Bullish Percent Index is telling you how many stocks on any given day are in a buy signal using their point and figure chart or a sell signal, right? And this is basically the percent that are bullish on any given day, and it's updated every day. The McClellan Oscillator is looking at the spread between two exponential moving averages of advanced decline data, completely different data set, but look at how similar. Now, again, not identical, and I think that's why different breadth indicators can be helpful. If you just look at the nuances of one versus the other, you can see that the McClellan Oscillator tends to spike a lot more quickly. Look at how quickly the McClellan Oscillator gets far from the zero line and actually tends to slope lower, while the Bullish Percent Index actually continues higher. And I think the reason is because when a market rallies, like off of the October low, you have that initial spike where there's some big up days. This causes the advanced decline data to turn higher, which causes the McClellan Oscillator to quickly go above zero. As a bullish move gets a little more further along, more and more stocks have been going higher, so that's good, but the pace of that advance actually tends to slow off a little bit, which means the McClellan Oscillator actually starts to slope downwards. even though the bullish percent index goes higher. So one notable difference between these two particular breadth indicators, I found the McClellan Oscillator, often these divergences after it goes above zero. One of the things to look for is just when you start getting higher highs in price but lower peaks in the McClellan Oscillator. That's something you don't get as much from the bullish percent index, but you do for this one. We have a bunch of different breadth indicators on the StockCharts platform, by the way, and I would encourage you to to explore some of the ones that we use. I have a breadth chart list. So if you go to marketmisbehavior.com/breadth, it will take you directly to a StockCharts chart list that I keep updated with all the breadth charts that I use. You are welcome to take a look at that list. Use some of the tickers that I'm using there. Create your own charts. Have at it, and good luck to you. Let's go to question number 2. Dave, what's the downside to the momentum-based approach you mentioned previously on the show? When we talked earlier, I forget if that was earlier this week, I mentioned a couple books on momentum investing, particularly Gary Antonacci's book, Dual Momentum Investing. What are the other ones that I would mention? Oh, Brian Livingston's book, Muscular Portfolios. There's another one by Jack Vogel and Wes Gray, I want to say, and I think it's called Value Momentum or Momentum Investing or some combination of those two. And I'm sorry, Wes and Jack, that I forget the name of it, but it's a really good book. And similar, all three of those are very similar. They talk about momentum investing and what it's like. And here's the overall assessment I would say with momentum investing. In general, it tends to work pretty well. And that's why if you Google momentum factor, you will see academic research, you'll see people backing up with models why the momentum factor, which is the idea that you buy things that are working and then they continue working for a period of time, that has tended to work very, very well. That's why there are momentum ETFs that are widely popular, and that's why that phenomenon continues to be talked about. And again, over multiple cycles, that has tended to work. Now, two potential issues that you will have with that momentum approach. The one will be, and I'd mentioned in my own portfolio that I do some things like this. I will tell you two issues. Number one are the drawdowns. So in a momentum-based approach, you will have, in general, tend to have stronger returns over the long term, but it often is more noisy. So you'll have big drawdowns. So a lot of financial advisors would struggle to employ a pure momentum strategy because their clients, and maybe you included, would not want to deal with a 50% drawdown, but with the opportunity to go up more than the market. So you get to the finish line in a pretty good place, but the journey, it's a tough race. And for some people, that's an important issue. The second thing, it tends to be a very concentrated portfolio. So if you're following momentum, you might have a small number of strong positions. And for a lot of people, it's not diversified enough. So again, I think it's less about the data, which has tended to be pretty good, and more about psychologically what we're comfortable with and being comfortable with accepting additional risk and accepting a concentrated portfolio. But if you can deal with those two things, your portfolio tends to do pretty well. And again, if you Google any of those things I just said, you'll find some good examples that back up why momentum investing is a pretty good approach. And again, that's I use versions of that in my own personal investing. I would encourage you to review some of those books and look at the data that they provide. I think is well articulated. Next question: could ETFs like JEPI and JEPQ be a good alternative to bonds and cash? Now, we could have a whole 1-hour webcast just on this question, so I'm going to give you the 3-minute version, but I'm making a note. This might be something I do some additional videos on to explain it. So if you're not familiar with these are two JP Morgan income ETFs. JEPI is looking at basically the S&P 500. The other one, JEPQ, is a NASDAQ version of that. And what these are basically doing is they have a pretty decent yield. So JEPI, it's, again, the idea is it's an actively managed portfolio. What it's doing is it's looking at the S&P 500, and it is actively weighting it to try to generate income. So it's leaning more into the value-oriented stocks that pay a little more. I know they use like covered call strategies to try to generate income and manage the downside risk as well. So here's the thing. Are these good things? So I will tell you, with any ETF or any exchange traded product, you need to do your due diligence. So there are expenses involved, there are management fees, and make sure you are aware of all of those things. I'm not going to recommend any particular ETF without suggesting that you do a good amount of due diligence on all of those sorts of things. Buy-sell spread is an important thing to look at as well. Liquidity, these are actually pretty liquid, meaning there are plenty of assets under management, so I'm not as concerned about that. But here's the issue with using it as an alternative to cash. While it yields pretty well, these things are designed to actually outperform the S&P in a normal market environment, right? Sort of quote unquote. The problem is recently, I would say it's been anything but a normal environment. This is usually not going to do better in a bullish phase, particularly a protracted bull market led by growth stocks, which is unfortunately where we're at right now. So the problem is, are you willing to accept higher income, but you're owning things that are not performing as well? And if mega cap growth dominates the returns, this is not going to do as well. And that's why the relative strength at the bottom has actually been pretty weak in 2023. The goal of this ETF, from my understanding, is to match the returns of the S&P, but then add additional risk management and additional income. The reality of what they've been able to do is that's going to work based on the construction, how they're using different instruments to create that. That's going to work pretty well in anything other than the kind of market we're kind of seeing right now. So the problem I would have was, is it worth doing this? You're making a bunch of assumptions about what might be a good opportunity. I would say a lot of things, if not most things, are a good alternative to bonds, because as rates are going higher, bond prices are just not in a great place and don't seem to be getting better. So I would much rather be in a high yielding account of some sort with cash or cash-like things that give you a good stable return than something like this, which is going to assume leadership. The good news is I do think looking at the value space is certainly a great opportunity. We've mentioned energy, which would be the types of things that an ETF like this might be a little more weighted in. Another thing is this is a little more equal weighted. If you look at the weightings in the ETF, it owns a little bit of a lot. And the problem is, again, when mega cap growth is leading, it's going to hurt the relative returns on here. So that's my sort of initial take on those two ETFs. Again, I would encourage you all to do your due diligence and make sure you understand the structures, because something like this is using a number of different things to try to create a particular performance profile. You always want to be familiar with those. Next question, which is more important when price faces resistance, the closing price or the high price? And I really appreciate this question, by the way, because I will and the short answer is the closing price is infinitely more meaningful. And I will tell you, and I'm picking a random example. I don't know if necessarily this is a great example, maybe. But what you want to remember is with any sort of chart, right? And let's maybe take this one, right? Look at this bar right here. So I'm looking at United Health Group, and again, I didn't really come up with a good example here. I just kind of picked one randomly, but I'm going to do this, and I'm going to zoom into the last year, which makes it a little easier to see. Yeah, let's focus on this period here. So when you have a stock like this, and we have a low price here in March around 455. We bounced off of it, and now we're coming back to this level. So this is the level of support that I'm looking at. Look what happens here. We trade below the level, but then we close back above it. That particular thing happens all the time. And if you think about the dynamics of this day, think about what investors as a collective were thinking during this period, right? This is a stock that's trading around 485 or so, and these are adjusted prices, so it might be a little different, but say it's around 485. The next morning, it opens down here around 451. So overnight, there's been a huge reset, and the stock is all of a sudden worth about $30 less than it was less than 24 hours ago. Now, one of two things can happen. People can see that and say, uh-oh, this is a disaster. I need to get out while at least I can get this, and all of a sudden, the stock would tend to go much lower. Or what you see here with United Healthcare, which it opens down to 450, and a big group of investors say, that's awesome. I thought United Healthcare was okay at 485, but at 450, this is fantastic. I'm getting in at a discount, and they buy, and this causes the price to go higher. And that scenario that I just described is what actually played out. So oftentimes, a lot of investors, not just you, would be focusing on a particular level of support and a particular level of resistance. By waiting for the close, you get a sense of what happened as we interacted with that level. And you will find this so many times. You will see a 200-day moving average, and we trade above it, but then close back below it. We'll have a Fibonacci level or a support level like this. We'll trade below it and then close back above it. And recognizing that, the direction of what happens between the open and then into the close, and the close as the most important number you can get at the end of the trading day has a lot of value. So intraday highs and lows, when you're thinking about support and resistance, interesting, but not as important as what happens once you close. All right, so trading through a level but closing above it is not a broken support level, and the opposite at the resistance. So I would encourage you to focus on the closing prices. And great question, by the way. Final question, then we will finish this week. Is it true that growth stocks have a run at the end of the business cycle? Really good question. Again, this could be another multi-hour scenario, multi-hour webcast here. I'm going to bring up, if you go to Charts and Tools at the top of our site, we have a free tool called Sector Perf Chart. What this does is it's a performance chart, so it's showing you the 11 S&P sectors and the S&P 500 as well. We're actually normalizing these returns to the S&P. So if I right-click down here and say year to date, I can see that it's been the 3 growth sectors: consumer discretionary, communication services, and tech, that have been positive for the year. Everything else is in a big way negative in 2023. Worth remembering this, right? When you think about the bull market of 2023, keep this chart in mind, right? It's not been great, depending on where you've been, and these are the things that have been underperforming the S&P year to date. Now, down at the bottom, we have Sam Stovall's model. Sam Stovall is a chief strategist at CFRA Research, spent a number of years at Standard & Poor's, and when he was at S&P, published a brilliant book, A Guide to Sector Rotation. And this chart is used with Sam's blessing to illustrate really an idealized cycle, and I think that's what I would remind you. Something like this is purely an idealized cycle. It is not like every market. I would love to tell you it's just this straightforward. It's not, and things will kind of lead or struggle times that don't make sense necessarily, because this is not a closed system. There are a lot of different inputs and a lot of different things that could drive sector and market returns at any given point. But if you look at the conditions here, a couple things to observe. Number one, the orange line represents the ideal market cycle, right? So early on, when a market's bottoming out, that's when you tend to look at the growthy stuff like technology and consumer discretionary to lead the way out of a market bottom. As a bull market becomes a little more mature, it rotates to more cyclical leadership, what you call late cyclical or late cycle leadership, like energy and materials. When the market tops out, you tend to see people get into defensive sectors like consumer staples, maybe healthcare. And when a bear market is firmly in place, you're in things like utilities, real estate, maybe financials. These are very defensive, kind of higher yielding places. But note that the business cycle lags behind the market cycle, right? The stock market is a leading indicator for economic conditions. So if you would say that we're in a recessionary period, which arguably we are, what should be working? Well, we're kind of all over the place. And I would say, what's happened is if we have gotten to a major market top, and you are seeing energy doing quite well here, which kind of makes sense. What we have not seen is any sort of transition to defensive sectors. And I think what has caused this to be a little different than normal is the AI craze really fueled growth sectors like technology and communication services, maybe in an off-cycle time, right? It's sort of an anomaly that they did so well. So I think we've become disconnected a little bit from sort of where we should be based on this idealized cycle. So to answer your question, in general, when the business cycle is actually still going down, when we're in a recession, that's where you tend to look for growth stocks to do well. So that is leading me and others to think maybe we're kind of back here where we haven't really seen this rotation to defensive sectors at all. If we still need to see that, that means that the economic data is slowing down. We haven't seen enough of that yet. We need to see much weaker economic data, and then only then do you look for signs of life from growth stocks. But that is a thing I would review. And again, Sam Stovall's book does a great job of explaining that. Again, I would just remind you, it's an idealized cycle. Idealized cycles like this look really good, but life is often kind of similar to this, but not exactly. Keep that in mind as you're checking out those patterns. We got to wrap the show, folks. Go to the 3 and 3, 3 charts in 3 minutes to tell the story of this market environment. Here's chart number 1. The S&P 500 overall chopping around quite a bit, finishing in a position of weakness, I would argue, through the course of this week. The breadth data continuing to get a little bit worse. Now 34% of the S&P members above their 50-day moving average, almost dead even 50%. It's a 50-50 shot. It's a crapshoot. If you take a member of the S&P 500 randomly and ask, are you above or below your 200-day moving average? We get below this level next week. If we sort of continue in a pullback phase, this all of a sudden is looking much more similar to bearish phases than bullish phases. That would cause me to think a lot more about downside protection, about downside objectives, in the major averages. Chart number 2, we didn't talk too much about sentiment indicators in particular, but I did want to highlight one of the sentiment indicators that I follow is called the Name Exposure Index. Another one is called the RIDEX Flows. Now, very quickly, the Name Exposure Index is the National Association of Active Investment Managers. That's not right. National Association of Active Investment Managers. These are like money managers, small hedge fund or mutual fund managers reply to this poll. And the survey basically asks what's your exposure to equity. So at 49-50% long equities, that's underweight the normal weighting, which is usually around 70-80%. So for the last couple of weeks, even with this bounce higher, money managers in this poll are still underweight equities. The RIDEX flows shows you within the RIDEX family, which are used more often by individual investors, are investors rotating more to the offense, things like long funds and sector funds, or defense, things like money management money market or income funds. And what's happened is RIDEX investors have actually remained fairly bullishly positioned here in the last couple of weeks. So you have this interesting justification where the quote unquote smart money is underweight stocks given the conditions, and the quote unquote not so smart money, unfortunately, as retail investors are tended to be considered, are still overweight or certainly more offensively weighted stocks. That usually leans to where the money managers are positioned. And so I'm concerned on the underweight that I see currently with a lot of money managers. Finally, charts like NVIDIA and Adobe and other growth leadership stocks, particularly in the technology space, showing continued signs of momentum divergence. And this is a classic technical pattern where prices are going higher, but the momentum is sloping lower. Higher highs in price, lower peaks in momentum. I'm seeing this pattern. These charts have not broken down yet, even though semiconductors showing signs of weakness outside of the majors like NVIDIA. But overall, while we haven't seen price deteriorate too much below the 50-day moving average, the momentum is suggesting a pullback is imminent. So these names haven't even broken down yet. What happens if NVIDIA and Adobe and others really start to break down in absolute terms? Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. As a reminder, all of our previous interviews are on our YouTube channel, so make sure you go back and check in on some of those great conversations recently. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great weekend.